Everyone, we are just going to be kicking off in just a second. We are going to let people get logged into the webcast, and then we're going to be getting started. So give us just 1 minute. Okay, we're in the interest of time, we are going to kick everything off. So welcome everyone to the SOA Affiliate Tech webcast, excuse me, Big Data, Ethics, and Insurance. Thanks so much for being here, and thanks so much for being an affiliate member. My name is Beth Gall, and I'm the Director of Candidate Engagement for the SOA. I'll be moderating the webcast today. So if you have any questions during the event, please add them to the chat, and we will have David answer your questions as we go. Please note that this webcast is being recorded and will be available on the affiliate YouTube playlist in the next few weeks. I'm excited to be joined at today's webinar by David Moore. David is the second vice president and actuary at Protective Life and is based in Columbus, Ohio. David joined Protective in 2021 and has over 20 years of experience in the life insurance industry and as an actuary and data scientist. David is a fellow of the Society of Actuaries, a member of the American Academy of Actuaries, and holds a Bachelor of Mathematics from the University of Waterloo. Thanks so much for joining us today.
Thank you very much, Beth. Great to be with you, and thanks to everyone for their interest in joining this webinar. Certainly, you know, my focus on data and predictive modeling in underwriting for life insurance is something that, you know, data is the very heart of what we do and what many of us do as actuaries, and certainly with the propagation of tools and technology to use data and the data that's available, the ethics around that is something that's certainly been very much in question. Hopefully we get the slides up here shortly and I can kind of dig into those. We'll have a couple polls to start off as we get, you know, just to get a feel for who is on there. So, but I don't know if you can get the first poll up while we're waiting, or while Trish is getting the slides up. Okay, there we go. There is slides. Okay. All right, so here is the first question, and just wanted to get a feel for who we have on the call today, and we can leave this up for maybe about 10 or 15 seconds, but just I want to, you know, are we looking with people who are just getting started, or you have some ASAs, or maybe some educators on the line as well. So if we can get that answered and we can, you know, get that probably closed up now and see who we've had answer so far. All right, so we've got a lot of people that are just getting started with exams, so that's great to know, and hopefully you can get a lot out of today's webinar in terms of you know, some of the new and emerging work that's going on in the actuarial field, as well as you know, this is not just a topic that belongs to insurance and actuaries. I mean, the way predictive models are used, you know, permeates many industries today. So all kinds of really fascinating applications. Maybe we can touch a bit on those. In this one I put up there, just wanted to know kind of what are people, you know, hoping to get out of this, and Certainly, can talk a lot about how I use data as an actuary, as a data scientist within life insurance. There's a lot of risks that around the use of data, which is causing some of the corresponding regulation that's starting to appear. But of course, we also know there's a lot of um, just risk of data and what companies are doing with that. There's so much data on us out there available today. So maybe it is a good reason that you should be getting rid of your TikTok and Instagram accounts. But maybe we can close this up. Okay, well, good. And then the last question before we kind of dig in. Let's see. And this is just kind of a poll to get a feel for what you think of some of the data is out there and some of the things that we have access to or other companies have access to. So which of the following would you be most uncomfortable with an insurance company using to determine your price for a policy? I mean, you can think of this as life insurance or auto or renters insurance, but do any of these trouble you if companies are using credit data or looking at your prescription drug history or looking at your social media? Hopefully, there's not a lot of criminal record out there, but that's something that companies are looking at as well or have access to. Or maybe you're fine with all of this. Maybe you think that it should be an open book and transparent about what personal data is out there on someone. And if we can close this up here, we can kind of dive in. Okay, that's interesting that there's a pretty good spread there. But close to half of you is social media. And that's actually something that I will touch on as we get into some of what's being done with life insurance. All right, so we'll move on. So as an intro, why is data ethics important in insurance and beyond? And certainly, as I mentioned, the volume of data and the speed of computation has grown so rapidly in recent years that it's enabled us to do a lot more with that data and take a deeper dive into what could be not just causational but even correlational to risk. And if we think about what companies have used traditionally, for life insurance, you'd have very specific medical questions, but then you'd need to go get doctor's records. Now some of that information is available right away that you can get through third parties, and you can avoid labs, avoid having to get 500-page faxes from a doctor to go over your entire medical chart. So there's not only is there the risk of using all this data, there's certainly a benefit in terms of speed and value that comes with it as well. And certainly you see parallels like that in other types of insurance as well. In terms of what's out there, and I think for a group of candidates that are starting their actuarial journey, getting into exams, that we're risk professionals, and this data helps us evaluate risk, and we need to be learning how to use these techniques to do our jobs. When I took exams, we did some statistics, we did some regression. I didn't know what a generalized linear model was at that point in time. Predictive modeling wasn't even something that was, in the lexicon, but that's now something that is going to be a necessary tool as you are going through the curriculum. And I think the society has always done a good job at adjusting the exams and the content to what is most relevant at that time. And so certainly the way we use data and computational tools has changed significantly, and that's something that you need to learn as a student. I need to learn as an experienced actuary. The regulatory aspect is certainly very important, and in some aspects, that as technology has advanced ahead of regulation, it's been a bit Wild West, or not as regulated as it could be, as it should be. You certainly hear things about. An example is Mark Zuckerberg or other tech executives being called to testify in front of Congress or the Senate about what's going on with their tools, what's going on with their privacy, and because it matters. I mean, there's so much that can be done with data, that and so much information about ourselves out there online, that whether we know it or not, that the government should be aware of this. And this is going on in both the insurance context from departments of insurance, but outside of insurance as well, and just general privacy laws. And I'll touch on a few of those as well. And I figured this was a good place to plug the actuarial standards of practice as well. And these will become probably more familiar to you as you go through the exam process. But the standards are really the backbone of what we do as actuaries and of our profession. And so when we talk about honesty and integrity, and as well as performing services when we're qualified to do so, that there's certainly an element of honesty and integrity within the way we use data, and certainly of understanding how to use that and some of the pitfalls. So it's a topic that is very exciting to me, because I think, again, it's on the forefront of how the actuarial profession is evolving to take advantage of this. If I go into a brief history of how have we used data in the past, using large data sets is not something that's new for actuaries. We go back to the 1700s when an actuary ran an experience study on lives at that point to look at what are the rates people are dying, and how do we use this data. And that's a real simple example of something that's still done today. It's just the amount of levels and the granularity in looking at subsegments of the population and causes of death and by certain risk classes that looking at experience and looking at the statistics and the probability behind that, again, is the core of our work. Again, it's not something new, but how has that evolved recently? And it's not something that has just happened in the last couple of years. It's really evolved over 15 plus years that we can talk about in terms of some of the recent evolutions and predictive modeling really exploding in the actuarial field. So in 2006, the CAS put on their first predictive modeling seminar. Some of the first, and it's all, as a life insurance actuary, I have to give credit that the casualty actuaries did figure this out first. In terms of using predictive models or using non-traditional data to segment auto risk. And some of the first models were a couple companies started looking at credit scores and seeing that if we take our traditional data points that we underwrite on and we add credit to that, we get this additional segmentation, and we can see that people with good credit tend to have less serious car accidents, and maybe there's a correlation, a behavioral aspect as well that can explain some of the risks someone has. So it was easier to do that on the casualty side because they're typically selling a 6-month or 1-year policy. Your experience emerges very fast, and so the ability to study some of these alternative allowed them to get there faster. So credit to the casualty actuaries for being the first innovators of using predictive modeling as a risk segmentation tool. The life side saw what they were doing and figured out, we're using a lot of these traditional data that comes from the medical field, and really that makes sense because we're looking at dread diseases and maybe family history of certain things, or looking at blood pressure, cholesterol, as some of the risk factors. But there's certainly going to be behavioral risk factors that influence someone's risk on the life insurance side as well. And so companies started dabbling that in about 2008. We can go back over 10 years now, and then there was a Wall Street Journal article about some of the initial forays in predictive modeling the life side. The article was actually entitled "Would You Buy Life Insurance from a Machine?" and was based mostly, I think, on a journalist having looked at a number of presentations from a society spring meeting, and so that's where that came from. Certainly, things advanced beyond that. The society had their first advanced business analytics seminar in 2013. Again, um, you know, showing actuaries tools like R to do statistical work, and to use this data. And again, that just propagated. LIMRA started a big data conference. Very focused, completely focused on the insurance industry. LIMRA being a life insurance trade group. The society, came around with, or I should say, the exam system. Kind of caught up in 2017 with the Predictive Analytics Symposium, and then sorry, with the exam system. Exam PA started in 2018. So that's something that, as you're looking ahead, hopefully that's the exam you're the most excited about. It would be if I was writing exams today, but again, a lot of that, the content on just knowing the fundamentals of how to work with large data sets, how to build models, how to look for patterns in that, and again, things that will become very important in your careers. And now here we are in 2018 and beyond, and now the regulators are catching on and saying, oh, look, companies are using these models to write business, to determine risk class and price. So they need to be involved as well. And the couple ones that I've noted, and these are ones that are ones working in industry that are important to us to understand, to be aware of, that may impact what we can and can't do as actuaries. So California was the first to put in a California Consumer Privacy Act, and this maybe mirrors some of what Europe beat us to. But in terms of, as a consumer, you have a right to know what companies have about you, what they're using, and so that certainly impacts us in terms of what data we can, when you're looking at PII or personally identifiable information, what you can use, what you can keep, and certainly, in addition to the right to know what companies have on you, there's a right for your information to be deleted if you don't want a company you've dealt with to continue to have that. And that can be something that maybe causes some trouble, some pain as an insurance company, because that data, that historical data, is important for understanding experience, understanding mortality risk, things that can take many years to emerge, and understand that where that mortality risk is. So something that we need to be aware of, and maybe that's impacted more in terms of our IT and our data scientists necessarily than the actuaries. But again, it's only something that's going to grow. In 2020, Virginia enacted legislation. 2021, Colorado enacted very similar legislation. And that's something that we're monitoring closely. There's not a lot of concrete guidelines or rules yet, just that they have the ability to do more to govern these. On the specific insurance side of things, New York put out a circular letter to insurance companies in 2019, and that is kind of the standard, or the most maybe rigid rules that we've seen so far on the use of data, and how we use it to price. And it certainly lays out that companies are responsible for what data they're using, in terms of that they have to be able to show that it does correlate to the risk, and that there's a statistically significant or an actuarially significant connection between the data you're using and the product that you are pricing. And it also had a bit of an impact in terms of the way it defined adverse impact, to companies as well, and that in that change maybe the way that we viewed the use of big data, and I think initially we designed programs such that we could pick out the best applicants or the lowest risk applicants and sort of put them on an express path, and saying that, well, we're not discriminating because if you don't get on this express path, then you're going through the traditional underwriting process, the one that's human underwriter driven, and everyone will at worst be treated the way it was before. But even that is maybe changing the definition and saying, well, even getting that express pass is slightly discriminating. So certainly a lot going on, and a lot going on recently that we have to be aware of, and it's something that again, not only are we focused on the models we build day to day, but what is going on in the industry, what is going on in the regulatory standpoint that's going to impact us. So again, to touch on why data is so important for insurance, and that insurance, it is a marketplace. We are putting a price on risk, and so risk is the possibility of a loss or an injury, the chance of loss, or the degree of probability of such loss, and that's something that actuaries, our job is to understand the statistics and the distributions of risk. And you think about the data we have, and just how much more data we have today that allows us to build better distributions and hopefully understand this a little better. And again, that's why we need to advance our skills, advance how we use them. From an ethics standpoint, and from a just what we use and what we're trying to predict, I think when we're looking at life insurance and some of the pushback around what we can and can't use, and whether we can use behavioral data, I think it's important for me to recognize that it's not just kind of a yes no, is there going to be a claim or not, what is the risk of mortality, but that our products holistically is a financial contract. And so it's at the same time as, yes, we are ensuring the risk of a whether it's a mortality event or a disability event, but there's also there's the risk of someone buying a policy and then deciding not to pay their premium, and it's something where if we've paid commissions and gone through the expenses of putting a policy on the books, there's that financial risk as well, that we take, and so it's not a one-way contract. It is a financial contract that there's a lot of assumptions that go into it around lapse and expense, etc. So I think important to recognize as well that the risk can take on many facets within a single contract. This hopefully for those maybe educators on here, something to think about as well is that data can be misleading, and this is a risk that as we get larger and larger data sets, there's an importance to understand what we're dealing with, and that data can be very misleading. Data can be misused, misrepresented, and I don't even have to go down the direction of how social media or Twitter can magnify potential misuses of data, but if I take a step backwards and say, this is something that you will see in a statistics class, Anscombe's quartet, where we have 4 data sets that show completely different relationships between the X variable and the Y variable. But when we take a linear regression, we get the exact same line. And so, the point here is just that don't let the model or the summary statistics sell you on the final answer. You have to understand data holistically. You have to go beyond the face value and see, well, what is really causing this model to look the way it does. You know, you need to test values. You need to see, will this model fit outside of the test set as well. And that's something that can be called model overfitting, where you have built something so specific to what your data set is that it's really useless in the real world after that. And so that's something I think, as we think about ethics, that's part of our job, is to look beyond the surface and understand what's really here. And so I find and find from my experience that as an actuary, we at sometimes sit between a few of the groups at an insurance company, you know, between the IT team that may be gathering a lot of this data, and the data scientists that are building some complex models, and the underwriters that typically, you know, understand the context of this data and the relationships of these data points to what the medical risks are. And as one who, you know, has a foot, you know, in the business world and the mathematical world, that sometimes, you know, what I can do and what I can do to bring value is to connect these groups and explain that, you know, here's what this data means, or yes, this model works, but, you know, maybe contextually it doesn't fit exactly what what this data says what it means as well. And to give you another example of one of the risks here of when you're using a large data set, is just the large, when you take a large sample and your p-values, in so if you're building you know, a very simple predictive model, and one that, you know, if you haven't learned yet, hopefully you will learn soon, is looking at a generalized linear model and seeing what variables have predictive power. And if you use a large data set, you know, especially within insurance, you know, if we're looking at data sets of, probably just for example, you know, if we issue 100,000 policies in a year at our company, we have a very large data set of underwriting data to use in a given year. So you may think that a variable is predictive, is significant, because it has a very low p-value, but it may, you know, have a correlation of 1.01. So it's only significant because there is that many observations, and it's not really practically significant. So that is something that I would say is going to be very different from maybe a theoretical, or you know, something you would do in a university class, as opposed to looking at the you know, contextually what something means when you're looking at a large data set of insurance policies. So that's another, you know, potential area or pitfall that we can run into as we're using large data sets. All right, I'll go into a bit of a case study and explain a little bit about, you know, what I do and what some of the models I use are for underwriting a life insurance policy. But maybe I'll just pause for a second. Beth, any questions have come in yet, or anything?
Yeah, we don't have any questions yet, but if you do have a question for David and what's been covered so far, feel free to put it in the Q&A, and we will have him answer it.
All right, sounds good, Beth. And for this, I guess, case study, I just wanted to give, you know, people a flavor of some of what I would use a model for, and some of the issues around the data that's available, and the data we can use or we don't use, and why. So, you know, a lot of what I've worked on recently is, you know, we're trying to assess the risk of an insurance applicant. You know, we'll specifically use life insurance because that's what I do. And this is something that traditionally it's taken maybe 4 to 8 weeks to underwrite a life insurance policy, because you get an application, then you have to send someone to the applicant's house to take a blood and urine sample. Those samples are sent to the lab. there may be some flags that show up either on the application or in the labs. And then you need to call the doctor's office, and then they're going to fax you um, their medical record, and then you're going to give that to an underwriter who's going to look at hundreds of pages and many things and try to figure out, okay, here's what we end up in our price. Um, that sounds like a process out of like the 1970s or 1980s, but something that's really still happening in some companies, and or some policies, and we're trying to do a better job making use of the data and technology that's available today. So let's look at the predictive model version of that process, which is someone now fills out their insurance application, and they may do it by a telephone call, that's maybe still 2000s. Maybe they're doing it online in an online form, and doing it on a digital application where they're answering a number of questions. In the background, once we get that demographic information, we can go out and hit a number of databases or third-party providers. So in addition to having their application data, we can get a driving record, we can get a credit history, we can get a criminal record, we can get medical data around your prescription drug history from either providers or your health plan. We can get medical claims. And I know this is the one that was the most red flags in the earlier question, that there's companies out there that can aggregate social media data. So that's kind of the universe that's out there for us to look at. And again, the applicant is hopefully going to have a better process. And right now the outcome is you pass the model. We don't, we can decide what your risk is based on the data we have, and we offer you a policy that day. Ideally it would be real time, like some credit cards are now. Realistically, maybe it's 15 minutes, a few hours. The alternative outcome is that you don't pass the model, and now we put you back in the traditional where you need to give labs and perhaps additional requirements. So that's where we are in terms of data that's used today. Let me see what my next slide is.
Hold on. So David, we got a question.
Yep. Okay, sure.
It says, in regards to one of the initial polls asked, do you see products like Apple Watches and Fitbits also becoming another means of determining a person's healthiness and risk? And then also, who or what determines what data is available for insurance companies to use in their determinations and what isn't?
Okay, that's a good question about the health trackers and wearables, and I'll definitely touch on that as we get into the next slide. And the second question around who determines what is available. Well, there's what I've listed. Those are things that are available today. There's a number of companies that are trying to make more data available, and trying to make those. People have data to sell, and people are trying to monetize some of this data, and so there's kind of this evolving industry of whether it's aggregating data, and traditionally you have some of the credit bureaus that do a lot of data aggregation, and have sold their data to companies more of in terms of a marketing application, right? So if you buy a pair of running shoes, then now you're going to get catalogs from a bunch of different athletic wear companies, right? And I mean, that's kind of old school. Now it's, if you click on a website, if you search on a website and they've tracked you on a cookie, guess what? Now your banner ads are going to be, oh, are you interested in this shoe or in this shoe or these jogging pants, et cetera, right? So there's a large industry for data and knowledge out there, and it's evolved very much as well now to where it is, point of sale is now digital, and so even again, you look at social media, it feels to me like it's like 50% marketing noise at this point. That people are throwing at you. So there's a lot of data that's available, and maybe what you can use is now determined by what you're allowed to use and what ethically you think you should use. So with that, I'll go to my next slide and think about, okay, how does that universe of data fit in with the existing regulations? And then what do we do, both from the perspective of the regulations as well as the perspective of, we don't want to be upsetting people or freaking people out, or having a headline in the Wall Street Journal that says, life insurance company X is using your TikTok video to determine how what your BMI is and what your health risk is. So the two things that really drive us right now are the Fair Credit Reporting Act and Hipaa. So if we want to be using data in our underwriting models, it has to be governed by one of these two rules or regulations, because that does a couple things. It means we need to get an authorization from the applicant to use it. So we are disclosing this on our insurance application. Someone has to sign off. Whether they've read that or not, we don't worry about that. But if they've signed off, it says, okay, you can pull credit reports, you can get data on me from certain reporting agencies for your underwriting. And then the HIPAA around health data, this allows us to get prescription drug data, medical claims data. It allows us to order medical records from your doctor. And these are done in conjunction with the other questions we ask around, who your doctor is, and when have you last seen them and why, and do you have these certain medical conditions. So again, these regulations also allow people to question, well, what was used for an adverse decision, what do you have on me, and if there's inaccurate, they can challenge it and correct it in the file if necessary. So what this doesn't cover is something like consumer marketing data, right? What are you shopping for online? It doesn't cover social media data. Those are things that we've looked at, and certainly there's other maybe marketing application models that you can use when you're just trying to contact someone and get that response. From an underwriting decision here, we don't want to use data that is not verifiable. So I think one example that was used in an underwriting article at one point was like, if I'm buying a case of whiskey, and putting it on my credit card, I'm buying it from a certain website, and is that hitting my consumer marketing data? Well, was I buying that all for myself to drink, or was I buying it, for a party, or was I buying it, for my brother's wedding, or so there's that context that's missing when you don't have the regulation that governs around it, and I think you can get some value out of that, but there's risk in making bad decisions or uninformed decisions based on that. And I think that really applies to the social media aspect of it as well. And that I think there's a wealth of information to be gleaned out of a Facebook or Instagram feed in terms of networks and interests. But from an insurance and a risk standpoint, I think it's dangerous and a slippery slope to go down there. It's certainly something that can be used for marketing, and a lot of companies that are not insurance companies are taking advantage of some of that data. So that's that's where things stand with that. Now, wearables, and I think that's a great question, because that is something that is emerging, and I see that very much as a parallel to telematics in auto insurance, right? Again, auto insurance beat us to this one. You get initially it was a dongle you plugged into your car's computer that would transmit information about how you drive to your insurance company. Now they've gone the next step and said, well, that's all on all those all the technology to do that tracking is on your phone, right? You can figure out how fast you're driving and acceleration, deceleration, geolocation. Um, Even are you playing on your phone while you're driving? So there's so now auto insurance companies have apps on your phone. Um, Tons of noise in that data, but companies have done a good job of distilling and have a few things that really impact the risk of driving. And some of them are pretty simple, like how often do you drive, how long are you driving, how often are you accelerating or hard braking, and so companies have been able to get a little better segmentation on those. But just the fact, interestingly enough, just the fact that someone is willing to plug that in and share that data with you was probably as predictive as the other data points they're getting off, right? You get kind of that honesty factor. So um, now wearables for life insurance, there are people certainly looking at it. There have been companies that, if you sign up for their program, they'll send you an Apple Watch or a Fitbit. They'll give you a discount, or they'll give you, incentives, rewards for, tracking exercise, eating healthy. And that's kind of, a two-edged sword, right? I think we don't have a lot of historical information to know necessarily how is that going to impact your mortality. Um, so, if I take 10,000 steps a day, what does that do to my mortality? What does that do to my insurance cost? I don't know. It's certainly better, probably better if you take 10,000 than 5,000 or 2,000. But how do you price that out? We don't have this huge historical data set. We don't have years of history on heart disease and blood pressure, or like we do on heart disease, blood pressure, cholesterol, et cetera, et cetera. But there's that same behavioral aspect you see on the auto insurance as well. Just the fact that you are willing to share this data with me probably means you're a better risk than the person that doesn't want you knowing anything. So there's that kind of transparency as well. Thus far, I think it's been better as a marketing device than it has necessarily to provide you that additional segmentation. And I say this because longitudinally, people don't, maybe interest or the ability to track comes and goes, right? And I think, some people, people that may buy that insurance product that wouldn't have otherwise, sort of that incremental value of offering it, are not necessarily the people that are going to keep their Apple Watch or Fitbit on for tracking purposes. And then how often do people want to engage with life insurance companies? That's been another challenge as well from a data standpoint. Everyone's trying to engage with you today. First, there was frequent flyer programs. Now there's frequent everything programs, right? People are always trying to give you points, and I think there's some fatigue in that as well. And is a life insurance company the one that you really want to be engaging with, and so maybe we need to connect that better to somewhere else. But it's certainly something that's interesting, and I think there will be, like some of this other information, that maybe there'll be more value in a third party marketplace for people that are tracking the data, and can give you that transparency. So but yeah, it's an open question. There's not a lot of regulation around it, and it's sort of this, in my mind, a gray area. There's potential there, but we'll see where that goes. Hopefully that it's a long answer, but there's also, I think, still a lot of uncertainty around exactly where this falls in, and some of it is just because it's so new. So I'll move on. I touched on a couple of the items around some of the regulation. This is a slide on the California regulation. Oh, just before I do this, Beth, any other questions or anything else?
So I think you're actually just about to go into the next question that we had.
Okay.
It's, what are some things an actuary should be doing to protect the data they receive, and used for analysis, such as security precautions. And so I think this directly connects with what you're going to be talking about, collection with the Privacy
Yeah,
Act.
yeah. Yeah, certainly. Some of the regulation in this is, you know, what's been enacted by California and is starting to be adopted elsewhere. And again, I think that this came very much, paralleled the GDPR in Europe, GDPR, sorry, around, data protection and rights. But as I mentioned a couple of these things earlier, you have a right to delete information collected about you, the right to opt out, right to non-discrimination. We haven't really touched a lot on discrimination, and that's maybe something that we need to touch on here as well. So yeah, certainly, making sure that your IT team and data scientists have the right infrastructure so that we can comply with this is important. And that's probably been the biggest challenge out of some of the regulation that has come in, is how do we make sure that we are following it? We want to follow it. We know we have to, but how do we make sure we do, and make sure that infrastructure is set up? And I know the non-discrimination here applies to, well, the person from the Consumer Privacy Act perspective, but at the same time, I think that a lot of what we are doing otherwise from an actuarial perspective, there's a broader non-discrimination topic as well, and that is, some of the data you can use and can't use. And I think I'll get into this in a couple slides as well, and some of the potentially proxy discrimination in testing the models. So I guess to summarize this slide is, yeah, you have to both work with your technology folks to make sure that you have the infrastructure built in order to follow these rules. But then you also have to be able to have a testing and review process on any actuarial or predictive models that you build to make sure that there's not any discrimination, intentional or unintentional, in some of the models that are being used for pricing. So, and to move from kind of the general California version to the specific New York letter, and maybe for perspective as well, New York tends to be a more challenging state from an insurance perspective, in that there's additional regulation and scrutiny there, and that has caused an interesting dynamic in that a lot of companies may have a separate New York entity in order to issue business there, and fall under the more strict New York rules, guidelines, etc. So when something like this comes out, it applies to business in New York and not the rest of the country. However, as an insurer, we're always looking at it saying, okay, what happens if the rest of the country adopts this? What happens if we have to have that level of response, across the board rather than just New York? But in this case, the onus is on the insurer to determine that whatever tools or data sources are not utilizing prohibited criteria. In that, you get into protected classes around, specifically, things like, race and religion, but, there's a number of other, criteria that you cannot touch, and you should not touch as in terms of making a decision, that are, irrelevant to what the risk that you're trying to manage. It's important here, the second point, that you can't simply have your vendor tell you, here's my model, go ahead, you can use it, it's approved. That the insurer is required to look at the impact of that model on how they're using it independently, to make sure that you're compliant with their laws, and so that becomes a challenge, and something that I think is probably something that actuaries, in addition to data scientists, need to be involved in from a company standpoint, in that you have to really understand the finer details of some of these statistical models that a third party may be providing to you to do some type of prediction. It also is a challenge because a lot of times the company that is selling you a third party model process has some kind of proprietary algorithm that they may not want widely disseminated as well. So it can I think it's important, but at the same time it can be a challenge to both the company and the direct company and the third party in the background in terms of innovating and allow and developing IP to sell to insurance companies, knowing that there has to be this transparency. And certainly the third point is that there has to be that the rating or the data, you have to establish that it's not that there is a connection that's not discriminatory, in addition to it being predictive, actuarially significant. Again, so it's a pretty high bar for what is expected in New York, because not as many companies are practicing or issuing policies maybe using accelerated underwriting in New York. It's not something that is probably been challenged a lot or pushed back on. I think companies have kind of stayed away, but are certainly thinking about how this applies to what they do elsewhere and how they build the process going forward. So proxy dissemination and disparate impact, and maybe an extension of what we're talking about in New York. And if you have a few hours, I would recommend digging into this for more details. But as we look at making decisions based on big data and models, that proxy discrimination is something that can happen where you are discriminating against a protected class by use of a different variable, right? And maybe to use a really simple example, is there's potential for something like this in credit, where that maybe if you are having in something that's been written about in other applications of using a credit score as well, that if a protected class is overrepresented in the area that you are adversely making a decision against, then you could be having a proxy discrimination if you can't show that, for example, that credit score itself is predictive of the segmentation you were trying to predict, i.e. mortality, car accidents or claims, house insurance claims. So and this becomes a challenge because we want to be selling insurance. Insurance is good for it's a common good, right? You are protecting people's wealth, and if you think about why insurance started up in terms of collectives, that it was a way of everyone contributing a little bit to save against a large claim for someone. So there's a communal good for insurance, and I think some of what as a life insurance company we try to make a case for and argue is that look at GoFundMe. People, there's a tragedy and people are not insured, and then now they're reliant on the charity of others, and if they for minimal cost, that's our goal is to offer this protection, but you have to plan in advance. So it's something where we're trying to we are trying to segment risk. We're trying to understand what is a good risk and what is a bad risk, and so we do need to discriminate between those good and bad risks, and the use of some of this big data can help us segment and drive the costs down across the board. But there's certainly risks that go along with that, and we have to be careful as an actuary and have to do our due diligence and understand how we are doing that. So this I certainly recommend. This is again a long article, and that gets very much into the details of it, if you have time for that. Another, and this one is, I think, a fairly commonly known book, Weapons of Math Destruction, but I think goes into some of the impacts of using data without necessarily understanding it, or some of the context and what it can do. And I think this gets into some of around, whether it's credit score models, or even police models it's possible for your models, the way they use data, to be kind of an echo chamber of what is going on, and not looking at the causation behind that, and can actually, when overly relied on, echo potentially the discrimination that exists. So again, this is something that from an ethics standpoint, people need to be aware of the dangers and the impacts of some of the of what we do and what we use. And again, it's we're kind of right on that edge where in insurance, where we're trying to provide a product that does a common good, provide that protection, and yet realize that there's a lot of data out there, and we want to be careful around what we do and what we don't do with it. So hopefully that helps explain that. All right, as we're wrapping up here, and we got a couple minutes left, I know I've rambled on a lot. I don't know if there's any questions we want to jump to now, Beth, but I have two polls based on just what I've said, what your understanding is, and there's no right wrong answers. Just curious to kind of see what people's thoughts are as we wrap this up. But should credit models be used for life insurance underwriting? You can give that a few more seconds. Any other questions, Beth, that have come in?
Nope, no other questions right now.
All right, maybe we can close this one and see where things stand. Okay, so either you're not too worried, or I've done enough to convince you that there should be credit is something that can be predictive, and we try not to use credit on its own. That there's models that use credit as one of the attributes, and again, trying to understand that behavior and responsibility on top of credit to give us something that's better in understanding the context. So now I think we've got one more. So this is similar but different context. Should credit models be used for screening job applicants? Never, on occasions where it's warranted, or always? And give like 5 more seconds there. Okay, we can wrap that up when we get a chance. Okay. Bit of a split. Yeah, I would say that it's especially, I think, using credit models. I think one of the soft spots we've observed in them is when people are just starting in their careers, that there's punitive elements around where you've lived, and student debt, whether you're a homeowner or renter. So I we're not that comfortable necessarily using them under age 25 is kind of what I've seen from my observations. But so I could certainly see, there's a strong argument can be made for A and B on this question. But anyways, I just wanted to give you guys a little bit of food for thought. And then, this last slide, and I've talked about some of the third parties that are trying to disrupt insurance, and they are using big data, AI, advanced analytics, and this is something, as someone who has worked for large incumbent insurers, we see these as a threat. As someone who's starting your career, you may be looking at these and saying, "Hey, this is a place where I want to work." But it's something, maybe some of the good coming out of the data and the technology is they're really forcing us to rethink the value chain of insurance, and how things are done and how things can be done efficiently. So at the same time, they're challenging, insurers. They're also, maybe showing that there's different ways, more efficient ways to do things. I think insurance is certainly taking longer to disrupt. I mean, you think about like a Rocket Mortgage and and now it seems like what used to take weeks to get a mortgage is now very much a quick process, and the big banks have had to follow what has come elsewhere. So maybe we're at a point where we're going to see more of this, more AI driven insurance. Again, like everything, it seems to take hold a little bit faster in the P&C side and then come over to the life side. But certainly it's exciting times and a lot of innovation going on in the industry. So and again, I think we're right at time here, but looking ahead, it's an exciting time to be an actuary in my mind. There's so much going on, so much innovation. Can we build custom solutions for people? Can we understand more of who the person is and what their needs are? And maybe that, instead of trying to engage with someone based on their Apple Watch, maybe it's more about using the data that's there and offering that right insurance product at the right time. But I'd say at the challenge with all that is we can make insurance easy and easier to get, but there still has to be that push to sell it. So when I first got into this accelerated underwriting, we were thinking it's going to go the way that the insurance agent's going to go the way of the travel agent. Everything's going to be self-directed, self-served. But I think we've quickly realized that's not the case, that there's got to be some connection. And insurance is not top of mind for people. It's important, but it's not what people think about every minute of the day. So it's still got to be sold. It's not bought. We can make it easier, but we still need to have that connection. So there's still going to be a human element, even as some of it transforms with the technology. So I think that is last slide. Again, thank you for listening to me ramble for an hour here. Beth, I don't know if there's any other questions or any other wrap-up item.
There's just one final question.
Okay.
It is, how can an insurer deal with a reinsurer when they are offered a model at lower mortality rates? However, there's a risk of data sharing directly to the reinsurer by the model. And are there any such cases?
Well, I'll say this, that insurers and reinsurers share a lot of data, and that is something that there's probably needs to be care taken in terms of what you do share with them, and making sure that you're not violating any of those regulations in terms of sharing PII. But reinsurers tend to have a lot of very close relationships and contracts written that allow most of that policy information to share. Reinsurers have also been a really good source of some of the innovation, and it sometimes can work as a middleman between some of the startups or some of the new products that they're seeing and bringing them to the insurer. As one who works on the direct side with some of the reinsurers, their perspective and larger data sets can actually give you a better view on the ability of a tool to segment data. So that's something that I would say, typically reinsurers and direct insurers have a very mutually beneficial relationship around the way data is shared, and are certainly looking out for each other and making sure that they're not doing anything they shouldn't be but again, it does add a third party to a contract or a fourth party. And given everything I've said around regulation, there does need to be due diligence about what is being shared.
Perfect. All right. Well, thank you so much for joining us, David. And thank you to everybody who attended today. As I had mentioned before, this will be posted on the affiliate YouTube playlist. So feel free to check that out and share it with your friends. Otherwise, thanks again and have a great weekend.
Yep. Thank you everyone for joining.